In the past 10 months, there has been a staggering number of over 3,000 bank branches closing down. Even Santander Bank has announced plans to close 16 locations in Massachusetts, with 5 of those being in Boston. Another well-known bank, Bank of America, is also set to close its Truckston branch in February of next year. It's clear that the banking sector is facing a tsunami of problems, affecting not only the large banks like JP Chase, Bank of America, and Wells Fargo, but also the regional banks and credit unions. These closures have likely impacted many communities, with people having to travel further to find a new branch. The reason behind this alarming trend can be attributed, in part, to a letter written by JP Morgan CEO Jamie Dimon to shareholders. In his letter, Dimon highlighted that the banking crisis is far from over. This revelation indicates that the situation is likely to worsen in the coming months, leading to further closures across the country. To raise awareness about this issue, it's essential to hit the like button on YouTube and share content that educates others about these developments. In the past, banks had reduced their reserve requirements, allowing some banks to lend money freely without holding any reserves. This resulted in an abundance of loans being extended, along with fees collected from various financial products such as mortgages and credit cards. However, the banking landscape is now changing. Due to higher interest rates and a struggling consumer base, banks are facing significant losses and problems. Consequently, experts warn that up to 190 banks could potentially collapse. This may seem extreme, but it raises an important question. How do banks generate profits? Banks make money by lending funds to consumers who have the means to borrow and repay. Unfortunately, many consumers are now pushed to their financial limits, making it difficult for them to borrow at high interest rates. To understand the severity of the situation, we must consider the assets that banks have heavily invested in. Banks have lent money on credit cards, resulting in record-high defaults. They have also invested in commercial and residential real estate, which is proving to be a risky endeavor due to negative equity and various market challenges. Consequently, banks find themselves burdened by a series of poor decisions. As a response to the impending crisis, large institutions like JP Chase are expected to expand their reach by acquiring struggling banks. This consolidation will lead the already significant institutions to grow even larger. Furthermore, recent trends indicate that loan defaults are increasing, reflecting a slowing economy. For instance, Wells Fargo recently entered into receivership after a default on a $157 million loan. There has also been a notable decline in credit card usage and an overall slowdown in loan repayments, indicating economic challenges. An additional factor that could impact the future of banks is the increasing adoption of technology and social distancing measures. Many individuals now conduct banking activities through their smartphones, reducing the need for physical branches. While this shift aligns with advancements in technology, it raises concerns about the absence of face-to-face interactions with bankers. It remains to be seen how this trend will impact the industry in the not-so-distant future. Chase Bank, for example, is set to close down 5 more branches, leading to concerns among customers about securing their money. Interestingly, this banking giant has closed more branches than any other bank in the U.S. They have been shutting down duplicate locations and focusing on expanding into new regions. Their goal is to have the right branches that serve the financial needs of their customers, which implies that they may prioritize higher-income communities due to their proximity and stability. This means that lower-income neighborhoods may be the first to lose out on banking services. JP Chase plans to close 3 branches next month, 2 in California and 1 in Indiana. Another Chase Bank in Indianapolis and another one in Shover will also be closed on December 1st. Their financial services arm, JP Morgan, intends to shut down 2 branches in Texas by the end of this year. These closures were officially announced on September 19th, and the first ones to be closed will be the Foothill branch in San Gabriel and Azusa, both located about 40 minutes east of Los Angeles. It is worth noting that in 2022 alone, around 3,000 banks have closed. Additionally, between 2017 and 2021, approximately 7,000 bank branches were closed, accounting for 9% of all bank branches. This means that in the last 10 months, we have closed half of the branches that were shut down in the previous 4 years. This trend is concerning, and it raises questions about the future of brick-and-mortar banking. Banks are not openly discussing these closures and job cuts, as they fear it may erode public trust in the banking system. However, it has been revealed that they have quietly cut 20,000 jobs this year alone. This number is massive, equivalent to a third of a football stadium filled with people working in bank branches. It is important to note that this figure does not include job losses in mortgage lending or related industries. Banks may be making these cuts based on the understanding of consumer behaviors and demands. They have a deep understanding of their market, perhaps better than anyone else. They have been closely monitoring the increasing number of bankruptcies, specifically commercial Chapter 11 bankruptcies, which have risen by a staggering 61% year-over-year to a total of 4,553 cases. It is important to note that these are individual bankruptcies, specifically within the commercial sector. This means that there have been 4,500 commercial bankruptcies in total. This alarming trend coincides with the decline in home sales, particularly in September, when home sales reached the lowest levels seen since the foreclosure crisis that occurred about 15 years ago. Additionally, home foreclosures have dropped by a significant 34% compared to the same period last year. Despite the overall improvement in the national economy and job stability, it is evident that some homeowners are still struggling with the financial aftermath of the pandemic or facing new challenges. While foreclosures are on the rise, it is worth noting that they are still far below the levels witnessed during the 2008 financial crisis. However, it is crucial to recognize that these challenging times mark only the beginning of what lies ahead. We are merely in the first inning of this economic downturn, and the situation is predicted to worsen in the upcoming months, particularly in November, December, January, and February. This projection is supported by various factors. Firstly, the consumer sentiment is wavering as inflation rates continue to rise. Federal Reserve Chair Jerome Powell has stated that interest rates will remain higher for an extended period, thereby straining the finances of consumers. Secondly, big investors are following a familiar playbook. Just as they did during the 2007 to 2009 financial crisis, they are hoarding cash to strategically invest in distressed assets. Esteemed figures such as Sam Zell and Hugo Stein, who amassed fortunes during previous economic crises, exemplify this strategy. Stein, in particular, capitalized on the Weimar Republic's inflationary period by borrowing depreciating currency and purchasing undervalued assets such as shipyards and large-scale real estate properties. The situation unfolding before our eyes is nothing short of extraordinary. It was unimaginable just a couple of years ago. However, we must prepare ourselves for what is to come in the years ahead, specifically 2024 and 2025. The middle class is on the verge of experiencing the largest wealth transfer in American history, which will create unparalleled investing and business prospects for smart entrepreneurs and investors who are well-informed, proactive, and possess a comprehensive game plan. These individuals are prioritizing areas such as credit repair, financial savings, online business opportunities, and the reduction of high-interest consumer debt. They are making the right moves at the right time, maximizing their potential for success. Now is the time to ponder the gravity of the situation and consider where it may lead. The closure of 3,000 bank branches may just be the beginning of a financial tsunami with the potential to reshape the entire economic landscape. Alternatively, it could be interpreted as merely a symptom of a larger problem that is already underway. We encourage you to share your thoughts and engage in a conversation regarding this matter.